I need to tell you about the most heartbreaking conversation I've ever had about money. It was about 10 years ago. A man came to see me at Berkshire Hathaway's office in Omaha. He was 72 years old, and he was desperate. He had worked his entire life as an engineer. He had saved diligently. At age 65, when he retired, he had $800,000 in his retirement accounts. Not a fortune, but enough to live comfortably if managed properly. But when he came to see me at 72, 7 years into retirement, he had less than $200,000 left. He had lost over $600,000 in 7 years, and he was terrified. He did not know how he was going to survive. His wife had health problems that required expensive care. Social Security alone was not enough. He was looking at the possibility of having to go back to work in his 70s or drastically reducing his standard of living just when he needed resources the most. What happened? How did he lose so much money so quickly? He made 5 mistakes, 5 common mistakes that I see people over 60 making all the time. Mistakes that are completely avoidable if you know what to look for. Mistakes that can destroy decades of careful saving in just a few years. Today, I'm going to share those 5 mistakes with you. And if you are over 60, or if you are close to 60, I need you to listen very carefully. Because if you are making any of these mistakes right now, you are putting your retirement and your financial security at serious risk. And the tragic thing is, most people do not even realize they are making these mistakes until it is too late. Before I tell you what those 5 mistakes are, I need to share some context about why people over 60 are particularly vulnerable. When you are 60 or 65 or 70, you are in the most dangerous financial period of your life. More dangerous than when you were starting out with nothing. More dangerous than when you were in your peak earning years. Why? Because you have accumulated wealth that can be lost, but you no longer have time or earning power to recover from major mistakes. When you are 30 and you lose money in a bad investment, it hurts. But you have 35 or 40 years of earning and saving ahead of you. You can recover. When you are 65 and you lose a big chunk of your retirement savings, you cannot recover. You are living on a fixed income. Social Security does not increase meaningfully. You are not going back to work in a high-paying job. If you lose it, it is gone. And that changes everything about how you should think about money. This is also the period when you are the primary target for financial predators. Scammers and unscrupulous advisors and salespeople know that people over 60 often have substantial savings. They know that many people in this age group are not as financially sophisticated as they think they are. They know that cognitive decline, even mild decline, makes people more vulnerable to manipulation. And they target you relentlessly with schemes and pitches and products designed to separate you from your money. I have seen it happen to people I know personally. Smart, successful people who built businesses and raised families and saved for decades. And then in their 60s or 70s, they made 1 or 2 catastrophic mistakes and lost everything. It is heartbreaking, and it is preventable. So let me tell you about the 5 mistakes. The first mistake is being too aggressive with your investments. This is the mistake that destroyed the engineer I told you about at the beginning. When he retired at 65 with $800,000, he made a decision that seemed reasonable at the time. He thought to himself, I am going to live another 25 or 30 years. I need my money to grow. If I just put everything in bonds earning 3 or 4%, inflation will eat away my purchasing power. I need to stay invested in stocks for growth. This logic is not wrong. You do need some growth to combat inflation over a long retirement. The mistake was in how far he took it. He kept 90% of his portfolio in stocks. 90% at age 65, when he should have been shifting to a much more conservative allocation. And not just any stocks. He owned a concentrated portfolio of individual stocks that his broker recommended. Technology stocks, biotech stocks, small companies that were supposed to have huge growth potential. For the first couple years, it worked. The market went up. His portfolio grew to over 900,000. He felt like a genius. His broker kept telling him how smart he was. Then the market crashed. I am not going to tell you which crash because there have been several in the past 15 years. But his portfolio got cut in half. His 900,000 became 450,000. He panicked. He sold everything and went to cash. This locked in his losses. He sold at the absolute bottom. Then the market recovered. But he was not invested anymore. He was sitting in cash earning almost nothing. Meanwhile, his living expenses continued. He was withdrawing money from his savings to pay bills. The combination of the crash losses and the ongoing withdrawals depleted his savings from 800,000 to less than 200,000 in 7 years. This is a tragically common story. People over 60 being too aggressive, suffering a major loss, panicking and selling at the bottom, and then being unable to recover. Here is what he should have done. At age 65, his allocation should have been no more than 40 or 50% in stocks, and those stocks should have been conservative dividend paying blue chips, not speculative growth stocks. The rest should have been in bonds and cash to provide stability and income. If he had that allocation when the crash came, his portfolio would have declined maybe 15 or 20% instead of 50%. He would have had bonds and cash to live on. He would not have needed to sell stocks at depressed prices. He could have waited for the recovery, and he would still have most of his 800,000 today. The rule is simple. As you age, you need to get more conservative. There are different formulas people use. Some say your age should equal your bond allocation. So it's 60% bonds. Some say subtract your age from 110 or 120 to get your stock allocation. The exact formula does not matter as much as the principle. The older you get, the less risk you can afford to take. By the time you are 70 or 75, you should have no more than 30 or 40% in stocks. The rest should be in bonds and cash. I know this feels wrong. When you look at historical returns, stocks beat bonds over long periods. You feel like you are leaving money on the table by being conservative. But here's what you need to understand. Those historical returns assume you stay invested through the crashes. They assume you do not panic and sell at the bottom. They assume you can wait decades for recovery. At 60 or 70, you might not have decades. And even if you do, can you emotionally handle watching your retirement savings get cut in half? Most people cannot. They say they can. They believe they can. But when it actually happens, when they see their account balance dropping by thousands of dollars every day, they panic. So be honest with yourself. If you are over 60 and you are still heavily invested in stocks, especially aggressive stocks, you are making the first mistake. You are taking too much risk. You need to rebalance to a more conservative allocation before the next crash happens, because there will be a next crash. I guarantee it. I do not know when. I do not know what will cause it. But markets crash periodically. It is part of how they work. And when the next crash comes, if you are over 60 and heavily invested in stocks, you are going to be in serious trouble. The second mistake is chasing yield and falling for products you do not understand. This mistake often happens right after people realize they made the first mistake. They get too conservative out of fear. They move everything to bonds or cash, and then they realize the income is not enough to live on, so they start looking for higher yields. And that is when the predators move in. Let me tell you about another person I know. A widow in her late 60s. Her husband had died a few years earlier and left her with about $1 million in savings. She put it all in CDs and savings accounts because she was terrified of losing money in the stock market. But the CDs were only paying 2%, $20,000 per year. After taxes, that was maybe $15,000. She needed at least $40,000 per year to maintain her lifestyle. Social Security gave her another $20,000. So she was $10,000 short. She was slowly spending down her principal, and she was worried about running out of money. Then she met a financial advisor at a seminar. He told her about a wonderful product that could solve all her problems. It was a variable annuity with a guaranteed income rider. He showed her projections, He said she could get 6% guaranteed income for life, $60,000 per year on her $1 million. That was way more than she needed. It sounded perfect. She signed the papers. She moved her entire $1 million into this annuity. Only later did she understand what she had actually bought. The 6% was not a return on her investment. It was a withdrawal rate based on something called an income base, which was different from her actual account value. The actual account value was invested in mutual funds with high fees that totaled over 3% per year when you added up all the layers. The insurance company fees, the mutual fund fees, the advisor commission. Her actual account value was barely growing. In some years it went down because of the fees and poor fund performance. She was indeed getting her $60,000 per year in payments, but it was largely coming from her own principal. The insurance company was just giving her back her own money slowly while charging her enormous fees for the privilege. And the worst part was she had given up all liquidity. She could not access her principal without massive surrender charges that would last for 10 years. If she had an emergency, if she needed a large sum of money, she was trapped. This is one of the most common mistakes I see. People chasing yield without understanding what they are actually buying. Variable annuities, indexed annuities, structured notes, master limited partnerships, non-traded REITs. All of these products promise high income. All of them have complex features that most people do not understand. And all of them have high fees that benefit the seller far more than the buyer. Here is my rule about financial products. If you cannot explain exactly how a product works and exactly how the seller makes money in 2 or 3 sentences, do not buy it. If someone is promising you returns that sound too good to be true, they are too good to be true. If someone is pressuring you to make a decision quickly before you lose the opportunity, walk away. It is a sales tactic. Real investments do not have artificial deadlines. Let me be specific about products that people over 60 should generally avoid. Variable annuities. The fees are too high and the benefits are usually not worth the cost. If you need guaranteed income, a simple immediate annuity is better and much cheaper. Indexed annuities. These promise stock market returns with no downside risk. It sounds perfect, but the reality is the returns are capped, the fees are high, and the surrender periods are long. You are giving up a lot for that downside protection. Non-traded REITs, these are real estate investment trusts that do not trade on public exchanges. They promise high dividends, but they are illiquid, the fees are enormous, and the valuations are often inflated. Many people have lost substantial money in non-traded REITs. Structured notes. These are complex derivatives that promise specific outcomes like principal protection with some upside participation. The fees are hidden in the pricing and you are taking credit risk on the issuing bank. They are almost never a good deal for the buyer. Master limited partnerships. These are investments in energy infrastructure that promise high tax advantaged income, but they create complex tax reporting requirements, they are volatile, and many have cut their distributions in recent years. Penny stocks and micro-cap stocks. If someone is pitching you a small unknown company that is supposedly the next big thing, run away. These are almost always scams or terrible businesses. Private placements and hedge funds. Unless you are extremely wealthy and sophisticated, you have no business in these. They are illiquid, risky, and have high fees. Cryptocurrency and NFTs. I have been very clear about this. These are speculations, not investments. They produce nothing. They are pure greater fool theory. At 60 or 70, you should not be speculating. Gold and precious metals beyond maybe a very small allocation. Gold does not produce income. It is a bet on fear, not a retirement strategy. What should you own instead? Boring things. Stocks of large companies that pay dividends and have been around for decades. Bonds from creditworthy issuers or simple bond funds. Cash in savings accounts or treasury bills. Maybe a simple, immediate annuity if you want guaranteed income. That is it. Nothing complex, nothing that requires a 50-page prospectus to explain, nothing that your advisor gets a huge commission for selling. Just simple, transparent, low-cost investments that you understand completely. The third mistake is not planning for healthcare costs and long-term care. This is the mistake that sneaks up on people because healthcare costs in retirement are hard to predict and can be catastrophic. Let me share some numbers that shock most people. The average couple retiring at 65 will spend over $300,000 on healthcare costs during retirement. $300,000. That is not including long-term care. That is just regular medical expenses, Medicare premiums, supplemental insurance, prescription drugs, co-pays, dental, vision, hearing aids, all the things that Medicare does not fully cover. And if you need long-term care, if you need a nursing home or full-time home care, the costs are even more staggering. The average cost of a nursing home is over $100,000 per year. If you need that care for 3 or 4 years, you are looking at $300,000 to $400,000 just for long-term care. Most people have not saved specifically for these costs. They assume Medicare will cover everything. It does not. Medicare covers hospitalization and doctor visits. It does not cover long-term stays in nursing homes. It does not cover most home care. It does not cover dental or vision or hearing. Supplemental insurance helps, but you still have significant out-of-pocket costs. I have seen people with $1 million in retirement savings end up on Medicaid because they needed nursing home care for several years and it depleted everything they had. This is why planning for healthcare costs is critical. Here is what you should do. First, understand what Medicare does and does not cover. When you turn 65, you are eligible for Medicare. Part A covers hospitalization. Part B covers doctor visits and outpatient care. Part D covers prescription drugs. But there are gaps. You need to decide whether to get a Medicare supplement plan, also called Medigap, which covers the gaps, or a Medicare Advantage plan, which is an alternative to original Medicare. This is a complex decision. A Medigap plan gives you more flexibility to see any doctor, but you pay separate premiums for Part D drug coverage. A Medicare Advantage plan bundles everything together and often has lower premiums, but you have network restrictions. You need to evaluate your specific situation. Do you have doctors you want to keep seeing? What medications do you take? How much can you afford in premiums versus out-of-pocket costs? Second, budget for ongoing health care costs. A realistic number is $500 to $800 per month per person for Medicare premiums and out-of-pocket costs. This includes your Part B premium, which is deducted from Social Security, your supplemental insurance, your drug plan, and your average out-of-pocket expenses. If you have chronic conditions or take expensive medications, it could be higher. Include this in your retirement budget. Do not assume healthcare will be cheap just because you have Medicare. Third, have a plan for long-term care. You have 3 basic options. Self-insure. This means you save enough money to pay for long-term care if you need it. If you have $1 million or more, you might choose to self-insure. But understand that long-term care could consume several $100,000 of that. Buy long-term care insurance. This is insurance that pays for nursing home care or home care if you need it. The premiums are expensive, especially if you wait until your 60s to buy it, but it can protect your savings from being completely depleted. The problem is that long-term care insurance has gotten very expensive. Many insurance companies have stopped offering it, and the policies have gotten more restrictive. You need to shop carefully and understand exactly what is and is not covered. Plan to rely on Medicaid. Medicaid will pay for nursing home care if you have almost no assets. But to qualify, you have to spend down nearly all your savings first. Some people plan for this by giving assets to their children years before they might need care. But this is risky. If you give your money away and then need care within 5 years, Medicaid has a look-back period and you will not be eligible. And giving away your money means you do not have it if you need it for something else. There is no perfect solution to long-term care. but you need to think about it and have some kind of plan, because if you do not, and you need expensive care, it can destroy everything you have saved. Fourth, consider a hybrid approach. There are some life insurance policies that include long-term care benefits. If you die without needing long-term care, your beneficiaries get the life insurance. If you need care, you can access the death benefit early to pay for it. These hybrid policies can be a reasonable option for some people. They are not cheap, but they solve both needs. The key point is, do not ignore healthcare and long-term care costs. They are one of the biggest expenses in retirement, and unlike other expenses, you cannot easily cut back if money gets tight. You need the care you need. Plan for it now while you can still do something about it. The fourth mistake is being too generous with adult children and not protecting yourself first. This is the mistake that makes me angry because it is often driven by guilt or manipulation, and it leaves elderly parents in terrible financial situations. I cannot tell you how many times I have seen this pattern. Parents in their 60s or 70s who worked hard and saved carefully. They have a nest egg of $300,000 or $500,000 or maybe more, not enough to be wealthy, but enough to retire comfortably if managed properly. Then their adult children have problems. A son loses his job and needs money. A daughter's going through a divorce and needs help. A grandchild has medical issues or educational needs. The parents want to help. Of course they do. They love their children and grandchildren. So they start giving money. $10,000 here for a down payment. $20,000 there for debt consolidation. $30,000 for a grandchild's college. They co-sign a loan for a child who cannot qualify on their own. They let an adult child move back home rent-free. And slowly, year by year, their retirement savings dwindles. They tell themselves it is temporary. They tell themselves their children will pay them back. They never do. And before they know it, they have gone from financially secure to financially struggling because they gave too much to their children instead of protecting themselves. Here is what I want you to understand. You cannot help your children if you yourself end up broke. If you give away so much money that you cannot afford your own retirement, that you run out of money in your 80s, what happens? Your children have to support you. You become their financial burden. You end up worse off, and you make them worse off. This is not generosity. This is foolishness. The right way to think about this is simple. You must secure your own financial future first. You must make sure you have enough money to live comfortably for the rest of your life. Only after you have secured your own future should you consider helping adult children. And even then, you should only help in ways that do not jeopardize your security. What does this mean practically? First, never give away money that you need for your own retirement. If you have $500,000 and you need all of it to generate income and maintain your lifestyle, you do not give away $50,000. You cannot afford it. If you have money beyond what you need, true surplus, then you can consider helping. But be honest with yourself about what is surplus and what you actually need. Second, never co-sign loans for adult children. This is one of the worst financial mistakes you can make. When you co-sign, you are legally responsible for the debt if your child does not pay. And statistics show that co-signers end up paying about 40% of the time. If your child could qualify for the loan on their own, they would not need you to co-sign. The fact that they need a co-signer tells you the lender thinks they probably will not pay. Why would you take that risk with your retirement savings? Third, if you do help your children financially, treat it as a gift, not a loan. Do not expect to be paid back, because you probably will not be. And if you are counting on being paid back for your own financial security, you are setting yourself up for disaster and destroying your relationship with your child. Fourth, set clear boundaries. It is okay to say no. It is okay to tell your adult children that you cannot afford to help them. It is okay to prioritize your own financial security. If your children make you feel guilty for not giving them money, that is manipulation. Do not fall for it. Fifth, be especially careful about letting adult children move back home long term. It is fine to help in a temporary crisis. But if your 40-year-old child is living with you rent-free with no plan to become independent, you are enabling dependence. You are harming them and yourself. Charge rent. Set a timeline. Make sure they are working toward independence. I know this sounds harsh. I know some of you are thinking, but Warren, family is more important than money. I should help my children no matter what. I disagree. Family is important, but helping your children does not mean sacrificing your own financial security. Real help is helping them become independent and self-sufficient. Real help is not enabling bad decisions or rescuing them from every problem. And real love sometimes means saying no. Your children are adults. They need to solve their own financial problems. You raised them. You gave them a foundation. Now they need to build their own lives. If you give them money every time they have a problem, you are preventing them from learning and growing. You are creating dependence. This is not generosity. This is harm disguised as love. I have a friend who is 80 years old. He spent his 60s and 70s giving money to his children, hundreds of thousands of dollars over the years. He thought he was being a good father. Now he is 80, his savings are nearly gone, and he is struggling. And his children, they still have their hands out asking for more. They never learned to be financially responsible because dad always rescued them. Do not make this mistake. Secure your own future first. Help your children in ways that encourage their independence, not their dependence, and never feel guilty for protecting yourself financially. The fifth and final mistake is not having a plan for cognitive decline and getting taken advantage of. This is the mistake that people do not want to think about, but it is critical. As we age, our cognitive abilities decline. This is not a moral failing. It is biology. Memory gets worse. Processing speed slows. The ability to evaluate complex information and make sound judgments deteriorates. This happens to everyone at different rates. For some people, it is mild and gradual. For others, it leads to dementia or Alzheimer's. But everyone experiences some decline, and this creates enormous vulnerability to financial exploitation. Studies show that financial scams disproportionately target people over 60 because scammers know that cognitive decline makes people easier to manipulate. They know that elderly people are often lonely and trusting. They know that you might not remember a conversation you had yesterday, so they can lie about what was discussed. I have seen people in their 70s and 80s lose hundreds of thousands of dollars to scams. Lottery scams where they are told they won the lottery but need to pay taxes first. Romance scams where someone pretends to love them and then asks for money. Investment scams promising guaranteed high returns. Grandparent scams where someone calls pretending to be a grandchild in trouble who needs money immediately. These scams work because they exploit cognitive decline and emotional vulnerabilities. The victim does not remember details clearly. They do not evaluate the situation logically. They act on emotion and urgency. And even when family members try to warn them, they do not believe it. They get angry and defensive. This is why you need to plan for cognitive decline before it happens. Here is what you should do. First, simplify your finances now. The more complex your financial life is, the harder it will be to manage if your cognitive abilities decline. Consolidate accounts. Get rid of investments you do not understand. Reduce the number of institutions you work with. Make everything as simple and automatic as possible. Second, set up durable power of attorney for finances. This is a legal document that designates someone you trust to manage your finances if you become unable to do so. Choose someone who is financially responsible, who you trust completely, who will act in your best interest. This could be an adult child, a sibling, a trusted friend, or a professional fiduciary. Make sure this is in place before you need it, because once you have significant cognitive decline, it is too late to set it up. Third, consider setting up a revocable trust. A trust allows you to transfer management of your assets while you are still alive. You can be the trustee while you are capable, but the trust documents specify who takes over as trustee if you become incapacitated. This provides continuity and protection. Fourth, tell your family about your finances. I know many people keep their financial information private, but your family needs to know the basics, where your accounts are, who your advisors are, what your wishes are. If something happens to you and nobody knows where your assets are or how to access them, it creates chaos. Fifth, set up alerts and monitoring. Many banks and brokerage firms offer alerts for unusual activity, large withdrawals, changes to beneficiaries, new account openings. Set these up and give a trusted family member access to receive these alerts as well. This creates a safety net. If you start making unusual financial decisions because of cognitive decline or because a scammer has targeted you, your family will know and can intervene. 6, be humble about your own abilities. I am 94 years old. I still run Berkshire Hathaway, and my mind is still sharp. But I am humble enough to know that I am not as sharp as I was at 70 or at 50. I have systems in place. I rely on my business partners. I have checks and balances. You should do the same. Do not be too proud to accept help. Do not be too stubborn to admit that you might not be able to manage everything yourself anymore. And finally, educate yourself about common scams. Know what to watch for. If someone contacts you out of the blue with an investment opportunity, it is a scam. If someone asks you to pay taxes or fees to claim a prize, it is a scam. If someone claims to be from the IRS or Social Security and demands immediate payment, it is a scam. If a romantic interest you met online asks for money, it is a scam. If something sounds too good to be true, it is. These 5 mistakes destroy more retirement security than market crashes. Being too aggressive with investments, chasing yield and buying products you do not understand, failing to plan for health care costs, being too generous with adult children, and not planning for cognitive decline. If you are making any of these mistakes right now, you need to fix them immediately. Not next month, not next year, now, because the longer you wait, the more damage they do. If you are over 60 with too much in stocks, rebalance to a conservative allocation today. If you own complex financial products you do not understand, get a second opinion from a fee-only fiduciary advisor who does not sell products. If you have not planned for healthcare costs, sit down with your budget and figure out how you will pay for Medicare and potential long-term care. If you are giving money to adult children that you cannot afford to give, stop. Have the hard conversation. Set boundaries. If you have not set up power of attorney and simplified your finances, do it this week. These steps are not optional. They are essential to protecting your financial security. The man I told you about at the beginning, the engineer who lost $600,000 in 7 years, he made 3 of these 5 mistakes. He was too aggressive. He bought products he did not understand. And he was too generous with his children. 3 mistakes. $600,000 gone. Do not let this be you. You have worked too hard and saved too much to lose it all now. Protect yourself.